I wonder if you could talk a little bit about that test for raising interest rates that you just elaborated. You've obviously made it very clear that you want to see improvements in the real economy, in the real data, and not in just sort of expectations data before making that move. But I guess I wonder what happens if inflation expectations were to move up before you see some sort of return to full employment. It seems like a lot of sort of the stability in inflation has been tied to the fact that those have been so low and stable. And I guess I wonder how your reaction would be, or sort of how your reaction to that is how you're thinking about that.
Right. So it seems unlikely, frankly, that we would see inflation moving up in a persistent way that would actually move inflation expectations up while there was still significant slack in the labor market. I won't say that it's impossible, but it seems unlikely. It's much more likely that we would, having achieved maximum employment conditions, we'd also be seeing 2% inflation and be on track to see inflation moving above 2%. They tend to move together. So that's not to say inflation might not move up, but for inflation to move up in a persistent way that really starts to move inflation expectations up, that would take some time. And you would think that it would be quite likely that we'd be in very strong labor markets for that to be happening. If that actually were to happen, though, there's a paragraph in the statement on longer run goals and monetary policy strategy which says that when the two goals are somewhat in conflict, we weigh various factors, including the time it would take to get back and forth. So it doesn't really tell you what to do, but it tells you that we will weigh those two factors and how far we are away from them and how long it would take to reach them, were we to reach that sort of pretty unlikely state.
Thank you. Steve Leisman.
Thank you. Mr. Chairman, I want to follow up on Janelle's question, and I wonder if you can help us understand better your thinking about how COVID infection rates and the virus calibrate with monetary policy. As you recall, we had a major resurgence in the virus last fall, and I'm wondering, would you need to be assured that there wasn't such a resurgence coming before you began, I mean, for lack of a better term, thinking about tapering? And what kind of comfort level would you need? Would it be something that would be declared from the CDC or the World Health Organization, for example, downgrading the virus from a pandemic before you had the comfort level to reverse course on policy? Thank you.
Yeah, we really have just articulated the goals that I've just mentioned a couple of times, which is substantial further progress toward our goals before we taper. Now, that's very likely for us to achieve that. It's very likely going to be the case that we've also made really significant progress on controlling the virus through vaccination and other. Those two things should more or less coexist. We haven't articulated a separate test for a state of the virus that we'd like to achieve, because we're not experts in that area. We're really focused on the economic outcomes. And again, my guess is that it's very likely, it seems to me, that for us to achieve the economic outcomes we would need to taper or to raise interest rates, we would also have to have made very substantial progress in getting the virus under control. Not necessarily fully under control. There is a possibility, of course, that we will have ongoing outbreaks over the summer, various regional outbreaks, and potentially next winter as well. But we'll be looking for substantial progress toward our goals, substantial further progress toward our goals as we think about tapering asset purchases.
Shepard Smith here. Thanks for watching CNBC on YouTube.